I am extremely pleased to introduce you to tonight's speaker. And I want to foreground a little bit by sharing with you one of the core values of the church, which was established by Eric Fischel and April Gornick, as many of you know. And the value that they personify and that we all hold very dear here, who work here every day, is the value that creativity exists in all people. And if you provide them with the opportunity and the métier to find their way in life, that it will be expressed. And so I say that because Howard Marks, who is known to many of you, people around the world, as being one of the foremost brains, if I may, in the world of finance. And there's a brain that's very lit, and an eloquence that's an approach that's lit by a tremendous amount of creativity. And that was the inspiration for tonight's talk, actually, was having lunch with Eric, who was blown away by understanding how that worked, seeing it in motion. So if you're not familiar, Howard Marks brings to us tonight 56 years of experience in finance, which includes educations at both the University of Pennsylvania as well as the University of Chicago. He is the co-founder of Oaktree Capital, and he's been extremely active in the world of arts and philanthropy as well, including being a chair or co-chair of the finance committee at the Metropolitan Museum of Art, as well as many other boards, including the board of the church. Yay, please clap. Please help me welcome Howard Marks.
Thank you, Sherry, and thank you all for coming and wanting to be with me today. And as Sherry said, she and Eric had the idea that I would speak to you, and so they picked the night when I have a dinner, so I have to be home in time for dinner, so I have to bolt out of here at 6:30. But I'll talk fast in the meantime. Just for my own orientation, who here is in the investment business? Ah, look at that, bunch of ringers. Among the others, who has investments? Who picks their own stocks? A lot. Okay, good. Okay. So, I was thinking in the last few days, what would I talk about? And there are a couple obvious choices. I can do, this is a stock and this is a bond and how they work. Or I can tell you about what's going to happen in the economy and the market next year, which I, like you, know nothing about. But that's, of course, what everybody wants to talk about. But what I want to talk about tonight, and what I'm going to talk about, since it's my mic, is I'm going to talk about 3 aspects of investment theory, which I think are absolutely foundational, which most lay people have never heard about, but which I think are essential to be an intelligent investor. So 3 aspects. And I'll take questions at the end, but in the meantime, if I say something that you don't understand, just raise your hand and I'll go over it again, because I want you to understand that. I want you to. It doesn't do me any good if I talk and you don't understand it, because I'm here for you to understand, because I actually think I understand it. So anyway, three foundational elements. Now, the first is something called the efficient market hypothesis. Who has heard of that? Okay, a lot of the efficient. We're starting already with that. The efficient market hypothesis. And basically what it says is that there are thousands or millions of investors, and they are, most of them, or some of them, intelligent, literate, numerate, objective, rational, computerized and highly motivated to make money. And as their joint efforts cause stocks, I'll just say stocks, but all investments, stocks to be fairly valued. You see? And if there's a stock out there and it's undervalued and people read about it, they figure it out, they bid for it in the market, they go out to buy it because it's a bargain, and their buying causes the price to go up. If there's a stock out there and it's too high, they study it, they realize that it's too high, and they sell it or sell it short. And their action causes the price to go down. So the bargains get raised in price, the overpriced securities get underpriced, and eventually the prices converge with something called fair value. So there's this thing called fair value. This is dollars. I'm not going to tell you what this is right now, but securities are priced like this. So some are below fair value and some are above fair value. But when all these people that I mentioned study the market, they buy the cheap ones and they cause the prices to converge with fair value, and they sell the expensive one and cause their prices to converge with fair value. So by the end of this process, it just looks like that. And all the prices, all the stocks are on this line, the so-called efficient frontier. Now, what's on this curve here, this axis, is risk. So there's an assumption, which I'll talk to in the second chapter. There's an assumption that people are risk averse, and because they're risk averse, they have to be, if they're going to make risky investments, they have to be tempted with incremental return. If I offered you, I have a treasury bill that'll guarantee a 7% return if you hold it for a year, or I can put you into a portfolio of venture capital startups in Silicon Valley and AI, and if we get lucky, I can make you 7%. Well, you'll take the T-bill because it's a sure 7 rather than an uncertain 7. Everybody likes certainty rather than uncertainty. QED, you have to be incentivized to take risk. So anyway, the efficient market hypothesis posits that because of the concerted action of investors, prices converge with fair value, everything is priced right, and you can't beat the market. That's the bottom line of what's called the strong form of the efficient market hypothesis. This is the stuff that Sherry mentioned that I went to University of Chicago, and I was very fortunate to get a graduate degree there in business. I went there in '67, and something called the Chicago School of Investing Theory had just been invented in '62, '64. So I was very fortunate to be among the first classes of students who were taught this stuff. And if you've read Malcolm Gladwell's book Outliers about demographic luck, which is right time, right place, this is an example. It's great to be born at the front of the line, and in this regard, I was. Anyway, so the efficient market hypothesis says you can't beat the market. And what I would say is it's not that you can't beat the market, but it's hard. And rather few people can do it. And when I went to Chicago, the professor said, and by the way, if you look at equity mutual funds, equities is another word for stocks. Mark Twain defined the profession as a conspiracy against the laity. And they use all these big words. But in the profession we say equities, but you people say stocks. So if you look at equity mutual funds, most equity mutual funds don't even do as well as the S&P 500 before fees, and then they charge you a high fee for their efforts, and they do notably worse after fees. So what they said when I was there is, why don't they just buy one share of every stock in the S&P 500? And that was something that didn't exist at the time, but it now exists, and it came into existence really in '74 when Vanguard organized the first index fund, which all it does is replicates the S&P 500, and it guarantees you S&P performance. And because there's no brain power required, no effort, there's almost no management fee, and it's dirt cheap and guaranteed to give you average performance. Now, average performance isn't so great, but it's great if on average most people do worse than average, which they did. Why did they do worse? Because they spent their time buy this, sell that, buy this, buy twice as much of that, and less of this, and buy that, and they paid commissions to engage in all those transactions, which didn't add any value because on average they weren't right. So this is the efficient market hypothesis. And when we were talking before, Sherry said to me, well, do you believe it? And my answer is that it is not correct, but it's relevant. And if you swallow it, you'll never make an investment, because you'll assume that your efforts will be for naught, and all you'll do is invest in index funds. But on the other hand, if you ignore it, you're going to get into trouble because it is relevant and there's a lot of truth in it. There are a lot of other investors out there. They're all trying hard. And my distillation of the importance of the efficient market hypothesis is very simple. The other people aren't idiots. That's what the hypothesis says, and it's true. I mean, it's like you're playing golf, and you think you're going to beat everybody just by going out there, but they happen to be pretty good, and they will be probably as good as you or better. So it's one of the biggest mistakes you can make in life, but especially in investing, is to assume that you're smart and everybody else is dumb. So, for example, you wake up in the morning, you turn on the TV, you say General Motors is at 64. You say, oh, I think it's worth 74. It's a great bargain. I'm going to buy General Motors. It's going to make $10. Easy. Why is it at 64? It's at 64 because thousands of investors have cast their vote that day and said, GM's worth 64. That's why it's selling at 64, because some people want to buy it there, some people want to sell it there, but on average, they're willing to transact at 64. If you say, no, it's worth 74, then you're saying they're all morons. Because on every transaction, every time GM trades at 64, somebody sold it at 64. Are they all stupid? Or are you stupid? And Charlie Munger, who was Warren Buffett's partner, once said to me, back in 2011, I think it was, he says, just remember, none of this is easy, and anybody who thinks it's easy is stupid. Charlie was very brusque and direct, but it's true. I mean, everybody's trying to make money. Everybody's best efforts combined have caused General Motors to sell at 64. And you're going to walk in and you're going to say, no, 74, and you're going to be right, and they're all going to be wrong? What's the chance? And that's what people do. They walk in and they say, oh, that one's too cheap, I'll buy it. That one's too expensive, I sell that. That one's too cheap, that one's too cheap, I'm going to buy that one. I'm going to exclude that one from my portfolio. This one, I'm going to double weight versus its weight in the S&P. This one, I'm going to half weight. And what is the probability that you're getting those decisions right better than others? So one of the things I believe very strongly, I mean, you obviously shouldn't be in the investment business if you think you're never right, but you are going to get into trouble if you think you're always right. And so a strong sense of humility has to inform everything you do in the investment world. So I write these memos, and I've been writing them since 1990. And I will refer to some of them tonight, probably, and they're all available at oaktreecapital.com under the heading of Insights, and you can get the 200 memos that exist so far, and you can subscribe to the new ones that come out, and they're also available. The new ones are now available in podcast form, and there are podcasts in which I discuss the old one, the best of the old ones, and why I wrote them and what they meant and all that kind of stuff. So you might want to look. And the best thing about them is they're free. And the other thing is, I was on something, and one of my colleagues was speaking about the memos. And the other thing is that if you go there and subscribe to the memos, we do not use your name to send you any junk. So you're not going to get on our mailing list for marketing if you read them. But I wrote a memo I mentioned to Sherry in '01 called "What's It All About Alpha?" In the Chicago theory. It's nice to get a reaction, because usually I say that, but if you say that on a college campus, you get no reaction. But you remember What's It All About Alfie with Dionne Warwick, and in the Chicago theory, we all the holy grail is alpha. Alpha is talent, it's skill, it's the ability to add value, it's the ability to look at all the stocks on the stock exchange and do the thing I said is hard to do, which is to find the bargains and find the overpricings. We call that alpha. That's our professional word for that. And so that was the subject of that memo. What's it all about? When I was at Chicago and I took my last course on investing, the final exam had one question. It was an essay: reconcile the Chicago theory of investing with the real world. And that's what that memo is an attempt to do. So you might find that interesting. So that was topic number one, which is the efficient market hypothesis. Topic number two is what I put on the board. It's the relationship between risk and return. And so there is this graph, and I'm going to change that from a dollar sign to return, which is basically the same thing. But basically, they showed us this graph every day, and it shows return on this axis and risk on this axis. And basically what it says is that as the risk increases, the return increases. That's why the line slopes up and to the right. That's what we call a positive correlation. The two are connected positively. A negative correlation is if one goes up, the other goes down. But these are positively correlated. If one goes up, the other goes up. Now, what many people are now aware of this graphic. Most of them, in my opinion, are aware of it incorrectly. And if you say to most people, what does it mean? What does this relationship mean? They say, riskier investments have higher returns. And if you want to make more money, the way to do it is to take more risk. Think about that for a minute. And I always found that incredibly unsatisfactory. First of all, if riskier investments could be counted on to produce higher returns, then by definition, they're not risky. So that can't be right. And so if it were true that taking more risk is the surefire path to a higher return, then it wouldn't be risky. Can't be right. So I was always unsatisfied with that. Now, the reason this relationship exists and is relevant, again, is because people are risk averse. Most people don't like uncertainty. They prefer certainty. And the other thing is the behaviorists and the psychologists have done a lot of experiments, and they have found in their mysterious ways that for most people, making $10 adds a certain amount of, let's say, pleasure or utility or whatever you want to call it. Losing $10 takes away much more. most people are more affected by losing an amount of money than they are positively affected by gaining that amount of money. And that means that we have what the psychologists, professionals call a nonlinear subjective utility function. So to graph it, if this is utility, good feelings, and this is dollars, then you would think it goes like this. As you make more dollars, you have more utility. But the way it really goes is like this. As you make more dollars, it kind of flattens out, and making 20 million isn't that much better than making 10 million. But as you lose money, as you pass the 0 point in the negative direction, it accelerates, and losing $20 feels a lot more than twice as bad as losing 10. Anyway, that's a digression. I'm sorry. But anyway, so people are risk averse. I think we can say that about most people. At Chicago, they said, well, why is it? This is kind of a little Chicago version of a parlor trick. But how can we prove that people are risk averse? And the answer is, because all you investors, who here in your stock portfolio only has one stock? Nobody has only one stock. Why not? Because you're risk averse. Everybody has a favorite stock. Why not just put all your money in your favorite stock? Well, you diversify your portfolio because you might be wrong, and because you are averse to losing money, or to losing, or to regret, or whatever have you. So anyway, it can't be true that riskier assets have higher returns. What this representation means, and remember I said before it is relevant, is that assets that are expected to be riskier have to appear to offer a higher return, or nobody will make those investments. That makes 100% sense, doesn't it? So that's what this relationship means, and that's the import that you should take away from it. So risk-bearing is not guaranteed to produce a better outcome, but it is something you can do to try to have a better outcome, and you'll have a better outcome if you get lucky, if you do it well. So I was never happy with the original formulation that riskier assets have higher returns, and so I imposed some this is what we call a bell-shaped curve in our business. It's a probability distribution that defines outcomes. Well, or not necessarily just outcomes, but I mean, let's say this is, on this axis, we have the height of people, let's say men, and this is the probability. So we know what the average height is, 5'10", and we know that some people are 6'2", and some people are 5'8", and once in a while you'll find somebody who's 5 feet, and once in a while you find somebody who's 7 feet. And so the distribution of heights follows a bell-shaped curve. And this is, we think about things. I hope that this is something you can follow. I hope it's useful to you. But this is how we think about things in making decisions, probability distributions. So what I did, by the way, the first time I ever was exposed to this was 1964. There was a World's Fair in Flushing, and IBM had a booth. And in the IBM booth, they had two sheets of glass separated by a bunch of dowels in a certain pattern. And they opened a slot at the top, and they dumped balls in, and the balls went like this. And by the time they settled down, they were in this distribution. Most of them fell close to the middle, a few of them a little further away, and once in a while one out here. And that's how life works, and that's how many things are distributed. Not everything, but this is a bell-shaped curve, and there's even something called the normal distribution, which is a special case of the bell-shaped curve with certain statistical properties, but it defines how many things work. Anyway, so what I did is I took some little bell-shaped curves turned them on their side and superimposed them on the line. I did it wrong. I have to do it again. Excuse me. Okay. Now, remember by the way, I didn't change the baseline. The baseline is unchanged. And in the last iteration, as you moved from left to right, when you increased the return, you increased the risk. And as I said, I think that gives the wrong impression because it suggests a dependable relationship. The presentation was so linear as to look regular. But now, if you take a little risk, you get your expected return is low, but there's not much uncertainty. Little risk. As you move out the risk parameter, the expected return, that's this part of the bell-shaped curve, the expected return rises, but the range of outcomes increases, and the possibility of the bad outcomes become worse and worse. That's risk. The first thing, this thing, did not portray that sense. I hope, can you follow this? But this is how the world works. As you do riskier and riskier things, you do it. Why would you do something riskier? Because you expect a better outcome. But why? What does it mean to do something that's riskier? It means you're accepting a wider range of possible outcomes, some of which are quite bad. So, the highest returning form of investing most of the time is something called venture capital investing. And you invest in startup companies, and you hope you're going to find the next Amazon or the next ChatGPT. And, the people who invested in Amazon when it started have made probably, 1,000,000 times their money, right? If you put in $1,000, then you have 1,000,000,000 today. I don't know what the right number is, but something like that. Amazon, for example, was $6 in 2001, and then I looked at it some year. I'm not in the stock business, so I don't look often, but the last time I looked, it was 3,300. So it went from 6 to 3,300. So that's a gain of 550 times. So.
The parents of related to Bezos put in 2 checks for $246,000. They were the first investor, and they now are $30 billion.
Yeah, there you go. Yeah. Okay. So they made 10,000 times their money, right? Great. Anyway, but something like probably 99% of all startups fail. Probably something like 90% of all the investments that venture capital funds make fail. So you have the possibility of really good outcomes and, of course, lots of probability of a total loss. That's what happens when you shoot high. You can shoot for less with less uncertainty, or shoot for more, but with more uncertainty and more probability of a really bad outcome. And that's life. And so everybody has to choose their own approach. And a given approach is not right for everybody. And you should choose your own. And so I wrote a memo last summer when I was here. And when I'm out here, I play a lot of tennis. and I play tennis. And then last summer I was watching the U.S. Open in Wimbledon, and so I wrote a memo called "More Winners or Fewer Losers." And if you want to have a better investment record than most people, which is that way, that's what you get paid for. If you have an average record, you don't get paid much. So everybody in the investment business wants to have an above average record, but in order to have above average record, if you're all the competitors and I want to beat you all, there's only two ways to try to do it. I can have more of the things that go up a lot than you do, or less of the things that go down a lot than you do. I can try to do both. It's very hard to do both because the people who have more of the winners are generally aggressive people who are better at risk taking, and the people who have fewer losers are generally conservative people who are good at risk avoidance. Not many people can do both. So the thing is that you have to pick your approach, which is, and by the way, if you look at these 5 investments that I've put up here on the board, which one's the best? No, there is no best. There's no best, there's no worse, because each one of them is a fair proposition relative to the others. If you take more risk, you get a higher expected return at the risk of a greater uncertainty and greater probability of loss. So one is not better than the other, they're just different. And one might be better for you, but a different one might be better for you. And so I think, so when I wrote this memo, fewer losers or more winners, basically what I was saying is everybody should pick their game plan. Picking a game plan doesn't mean you're going to succeed at it, but it's hard to succeed at any game plan unless you've picked it and worked hard to make it work. So anyway, that's number 2, the relationship between risk and return. And basically, just like I was ambivalent about the efficient market hypothesis, I'm ambivalent about this. You can't expect to make a lot of money just for taking risk. The old way of looking at it says risk-taking pays off with higher returns. That's silly. You can't expect to make money just for taking risk, but you can't expect to make money without taking risk. So you have to have a healthy relationship with risk. Anyway, that's number 2. Then number 3, I want to spend a little time on market cycles and what causes them. So, I got it. It's good. So this is how things go. This is time, and this is, again, we'll say dollars. And the economy kind of goes like this. It describes a straightish line. It rises over time. On average, the economy grows. Doesn't always grow, and once in a while there's a recession, which means it shrinks. And sometimes it grows a little faster, a little slower. Sometimes it grows by 3%, sometimes by 2%, sometimes by 4%, sometimes -1. But the variation is small, and so this line undulates gradually. That's the economy. Corporate profits grow like this. They fluctuate more because companies have what's called leverage. Financial leverage and operating leverage. Some of the costs are fixed. So a lot of the costs of running a business are fixed. You have a factory, you have a workforce, and so like that. And if the amount of business you do doubles, your costs don't double because a lot of them are fixed, so which means your profits quadruple if your business doubles. But it works in reverse too. Leverage works in both directions. So that's what we call operating leverage. So, but because of leverage, corporate profits are much more volatile than the economy. But then we have stock market, which looks like this. And what accounts why does the stock market fluctuate so much more than corporate profits? By the way, when you buy stocks, what you're buying is a piece of corporate profits. So if the thing that you're buying into fluctuates a little, why does the price of that thing fluctuate a lot? It's emotional. That's right. Human psychology, investor psychology, sentiment. You get an A. Thank you very much. A+. Okay. But anyway, that's why. And, one of the things I say, I wrote a memo called What Does the Market Know? And I said in there that in real life, things fluctuate between pretty good and not so hot. But in the minds of investors, they go from flawless to hopeless. And that's why this swings so much. And it's important to know that. And by the way, it's also important to know that the market doesn't know anything. And the market is a bunch of people, and they're not as rational as the efficient market hypothesis says. They're run by emotion. So I wrote a book in 2017-18 called Mastering the Market Cycle. And I've been through a lot of cycles, and I've studied them, and I've tried to learn from them, and I tried to understand them. And I get two-thirds of the way through writing this book, and I said to myself, just a minute, why do we have cycles? Can anybody tell me why we have cycles? Pardon me? Yes, humanity. That's right. And what happens is, sometimes people get too optimistic, and they push things up because their view of the future is rosy. Then sometimes, and then the prices get to the point where they're too optimistic, embody too much optimism. The optimism is not fulfilled. They experience disappointment, and the prices come back down to earth. But given human nature, they go through fair value to something on the other side. So rather than, if many people, if you say, what's a cycle? They say, oh, it's this pattern of ups and downs. It's not helpful to say ups and downs. The way to think of a pattern of cycle is excesses and corrections. So for example, let's look here. What's happening here? Look, the economy's doing okay. Corporate profits are rising. So we have pluses. The economy is positive. Corporate profits are positive. Stock prices are positive. That causes wealth to rise, and that causes psychology to become more favorable, and that causes people to become more risk tolerant. Remember I said people are risk averse? Sometimes they forget to be risk averse, and they become risk tolerant. Why do they become risk tolerant? Because they believe that the more risk you take, the more money you get, which is a great trap. And, it works until it doesn't, at which time you're punished. But these are all the things that happen in the up cycle, and it causes prices to rise from what we might call fair value to, I would say, overvaluation, and then eventually to reach something called a top. So that is an excess. But people get too optimistic. Their hopes and dreams are not fulfilled. They're disappointed, and then things start down. And after a while, the economy doesn't do so well, and corporate profits also falter, and security prices decline rather than rise, and wealth shrinks, and psychology contracts, and then people become extremely risk averse, and that causes a decline, what we call a correction. But if it goes too far, through fair value, it heads down here and eventually reaches what we call a bottom. So this was an excess of optimism This was a correction of that optimism, which turned into an excess of pessimism, which then is corrected by a move back toward fair value. So rather than think of a cycle as being ups and downs, think about it as excesses and corrections in both directions. And if you can have a sense for what's going on, you can have a sense for whether things are fairly priced or overpriced and why. And I put out a memo last Wednesday called The Calculus of Value, which talks about how price oscillates around value in great extremes. So, since the element that causes the ultra fluctuations of the red line is psychology, it's a great help to have a sense for what's going on in people's psyches at a point in time. And, if somebody brings out a new fund, is it sold out the next day or does it languish unsold? That gives you an idea about whether the environment is hot or cold. And in short, you don't want to buy when the environment is hot and everybody else wants to buy. You want to buy when nobody else wants to buy. That's when you get the bargains. So being alert to excesses and corrections, which cause the cycle fluctuations, I think is one way to ensure self-preservation. So that's the third thing I want to discuss. And now we have 12 minutes for questions.
So I think, Howard, we have so many questions in the room that we're going to go to them and skip my questions. That's good. Wow. Okay. So many. I think that was you were the first hand up, and then I'll come back to Kathy.
Thank you so much. About market cycles, do you think there's something different in these last years that the cycles have become much shorter and the reactions have become much faster in terms of the market correcting, especially on the way down? What has changed compared to even past crises that were much longer and much more difficult to correct? And secondly, if you had to pick one area to take a big risk, which area would you take a big risk in the market?
Today or ever?
In general, general.
Well,
where do you think the big risk compensates?
Yeah, sure. As to the speed of fluctuations, on the one hand, one of the biggest changes that's taken place in the investment world since I joined is investors' time frames. Because when I started, we used to think about it. I started at Citibank in the investment research department. We used to think about investments as lasting 6 years. Now, very few last 6 months. And everybody's trading, and everybody cares about what was your return last quarter and what are you going to make next quarter. And these things really don't matter. And an excessive concern with the short term is really a way to go wrong. And ignoring the short term, in my opinion, is really a way to get an advantage over other investors. But I think that, the fact of the matter is that everybody's looking at short-term performance. By the way, if you go back, let's say 50 years, before computers were widespread and so forth, you would run I was at Citibank, where you'd run a portfolio, and the year would end, and 3, 4, 5 days later, you would find out what the rate of return was that year. They had to do a bunch of calculations by hand. Today, you can look at your Bloomberg machine on your desk in your office, and you know your rate of return to this minute in real time. And this, given human nature, this encourages short-termism. And you know, if you know that you're up 4.6% this month and everybody else is up 4.8%, you freak out and you engage in all this trading to try to get better. So I think that is it causes quicker reaction times. And of course, we might as well jump on the bandwagon and blame social media, which is responsible for everything else bad in society. But you watch the shows on TV, and you get somebody on. He says you should buy, and so people buy, and then the next guest says you should sell, and things go like this. So I do think that. But on the other hand, when you make an observation like the fact that things are fluctuating more, you have to realize that we make generalizations in life by looking at a large sample. If you said to me, what's the height of the average person in Sag Harbor, and I based it on the height of the next person to come through the door, that would be a mistake. You need a big sample to make generalizations. And when we make generalizations like the reaction time is shorter, we have a small sample. We've only had 2 crises so far this year, this century. The century is a quarter old. We've had 2 crises. So generalizing about what is true from a sample of 2 in 25 years is a weak proposition. Now, what to invest in? I'm not good at that, and I hate to do it because I would be terrified that I would say something and you would buy it, because I won't buy it. But in general, I'll just say that if you think about this is helpful, I think, in investing life. You think about 2 piles of assets. And on this pile of assets are the things that everybody knows about, feels they understand, feels good about, or optimistic about, find respectable, and find positive. And then on this pile, you have the things that people may not understand fully or don't think they understand, find a little bit disreputable or tacky or risky or scary, or they're pessimistic about. Okay, where are the bargains? Second pile. So in general, it's a bad idea to buy the things that everybody loves, and it's a good idea to buy the things that everybody hates. Or I should say, you wouldn't buy everything on this pile, but you would look in this pile. And that's what I've done all my life, and I was very fortunate to, again, get to the front of the line on a couple of weirdo asset classes like high-yield bonds in 78 and distressed debt in 88, which were unloved and disrespectable, and that's how you find bargains. So, the thing I've been telling people about, and I absolutely don't recommend this to you, but I've been saying China. Because, a few years ago when China started behaving outrageously, people started to say China is uninvestable. That was the word they used, uninvestable. And if everybody sells their Chinese holdings and refuses to buy new ones, then there's a good chance that the price is low relative to the merit, and that's a buy. So that's just an example. Question over here. My A+ student.
Well, I don't know. I'm going to be a little controversial here. Okay, so we're talking basically about investments that are classical investment in a world like today. Obviously, things are changing, the value of money, and so my point, in that risky, like I don't want to touch this stuff, although it's becoming seemingly more attractive, is of course Bitcoin and gold, and as diversity in the portfolio and also creating less risk. I know, okay, Bitcoin is very volatile, but every low is higher. It's always higher, huh?
Okay, yeah.
And also, as a protection against the value of the currency. So I just wanted to bring that up because,
Well, this is one of the top 5 questions these days, and has been for, I think 2017 is the year that Bitcoin exploded into people's consciousness. So for the last 8 years, people have been asked about Bitcoin, and gold is connected to it because of their similarities. And I wrote a memo in 2010 called All That Glitters, which I talked about what I know about gold. And I apply a lot of the same reasoning to Bitcoin. In my opinion, in the investment world, there are 2 kinds of assets. There are assets that produce cash flow. What are they? Stocks, bonds, companies, buildings, all produce cash flow. And if you see a building or a company or a bond that throws off $1 million a year in cash flow, you can put a value on it. Some people would buy it for 9 million. Some people would stretch and buy it for 11 million or 12 million. But you can talk about what's the fair value. Then there are a bunch of assets in the world that don't throw off cash flow. Diamonds, furs, paintings, a barrel of oil, gold, and Bitcoin. They don't throw off cash flow. And so I several times in my discussions tonight, I talked about something called fair value. And if something doesn't throw off cash flow, you can't say what the fair value is. And look at Bitcoin. You can say you think it's going up. Somebody else may think it's going down. But you can't tell me what the fair value of a Bitcoin is, which means to me, and just the same as gold, by the way, which means to me that you can't invest in Bitcoin or gold or diamonds or paintings analytically. You can, because what is the price on those assets? It's what the market will bear. It's what the seller will pay. But you can't justify it analytically. And so if you read the memo, All the Glitters from 2010 about gold, I conclude that you can buy it if you want because you think it's going up. You can buy it as a superstition. You can buy it the way many people do because they're afraid that if they don't buy it, it's going to go up and they'll kill themselves. FOMO. But you can't buy it analytically. And I think, I happen to think that the same applies to Bitcoin. Just me. Okay.
You are out of time, I believe.
Well, one more.
You want one more?
Really short
Okay,
answer.
great. We have two, I don't know.
Don't fight.
So many. Howard, please pick one because there's so
All
many
right,
people.
over there.
Okay.
Howard, thank you so much. This has been terrific.
Sure.
So you, on your April 12th, I think, memo, maybe it was April 13th, you talk about DEF CON, and you talk about sort of overvaluation. Do you have a view on what asset classes or, are bubble-icious? I mean, is AI, going to continue, or do you think that the valuations are just absurd? And also, as a historical distressed debt investor, there's one of the largest companies in the world that's been in conservatorship for 17 years. Do you think Fannie Mae gets out of conservatorship, and is there value there?
Okay. So, remind me of the first question? AI. Yeah. Okay. Well, okay. Whenever, the easy way to say it is whenever there's a bubble. But in truth, whenever there is a surfeit of enthusiasm for an asset class, it is usually where there's something new. It's the new thing. Because it's very easy for excitement to coalesce around the new thing. First of all, it's never been seen before, so the restraints, the limitations aren't obvious. Secondly, there's no history. So you can't, you can't say, well, this has always happened in this industry or something like this. And whether it's the nifty 50, that Xerox, IBM, Kodak, and Polaroid that were flying high when I joined the business in '69, or disk drives in the '80s, or internet in '99, or maybe AI today, the limitations are unimagined and the imperfections have not come to light. So the excesses in the markets usually occur around the new thing. And certainly AI is the new thing. And, certainly AI will change the world. And I think that the world in 5 years will be unrecognizable from what it is today in good ways and bad. And so, AI stocks are on fire, and NVIDIA and so forth. Back in '99, the mantra was that the internet will change the world. And as a consequence, people said, thus, there is no price too high for an internet stock. And guess what? The internet changed the world. Can you imagine the world today without the internet? And yet, I imagine that 99% of the internet stocks that came out are worthless today. So so the progress of the new thing is not the same as commercial success for the companies that participate, and because so much is on the come with regard to an exciting future, it's very hard to have discipline as to value. And there are two other phenomena that I'll just touch on and then run out of here. One of them is that we get what we call a lottery ticket approach. And you say, well, if I buy it, it may only have a 2% chance of staying in business, but if it stays in business, I'll make 1 million times my money. So I got to do it. But what you're saying is 99% of the time you threw your money away. So it's the intoxication of the upside that forces people to action. And the other thing is when you have a bubble surrounding a new thing, people assume basically that the companies that are today's leaders will be tomorrow's leaders, which is always in doubt, and many of the other companies will succeed too. And usually those assumptions are shaky. So you can only invest in the new thing with trepidation. So I hate to have to run out of here, but I want to stay on my wife's good side. Thank you.
Thank you so much, Howard. Thanks, everybody, for being with us. Have a wonderful evening. Stay dry, and we'll see you again soon.